you may have heard, prediction markets are great. And the main reason they're great is that we have this data that says they consistently beat alternatives in head-to-head comparisons for accuracy. And that's this great potential that we somewhat understand. We have some theories that roughly tell us why that should happen. And these markets give us numbers all the time that are consistent, hard to manipulate, all sorts of great stuff. We've been working on technology for prediction markets for many decades now. And I just want to mention that there is actually a bunch of advanced tech behind the scenes that nobody's been using and maybe not used for a while. But I want to mention that it's there, called one of its combinatorial prediction markets. That is, you can have a set of claims and then have a full joint probability distribution over that entire set of claims and have a market that gives you a set of status quo claim estimates, and people change any part of that distribution. And in fact, we made a system like that over a decade ago where we had over 1,000 claims and we let people edit any part of the distribution. We had a Bayesian network representing that, and that's something the world could do when it's interested. I'm kind of spotty. All right. But for a long time, when I've said, what's the big potential? I reasoned the value of information is to inform decisions, and therefore we should have markets right next to decisions. And decision theory says, make the choice that has the highest expected utility given that choice. And if we could have market prices right next to decisions like this, estimating the outcomes of a decision given particular choices, that would be the strongest information we could give people, and there'd be a huge demand for that. And that was the concept of decision markets. And that's what I've been the most interested in for over 30 years now. And most of that 30 years, I wasn't getting much traction, but now in the last few years, stuff is happening. So here's the core concept. You have some decision an organization is going to make, and you have some outcome metric that tracks what the organization wants. So for a for-profit company, it might be the stock price. A crypto company, it might be a coin price. You've got a market in that price. And then at some point, you split the market into two markets, each conditional on a different choice. So you get the value if yes, value if no for some yes or no decision. And then during a period of time, you look at which price is higher in that period. And then whichever price is higher, this is recommending that choice. So then usually you make that choice. And then afterward, the market that's unconditional continues given the choice you made. This is what I've called Futarchy or decision markets. And this is what I think has huge potential. And we've actually seen versions of this. So for many decades now, we've had markets in US presidents in elections and who's going to be nominated and who's going to win. The ratio of those two is win if nominated, and that's advice to the party about who to nominate. That's a decision market. And in the last US presidential election, at Manifold, yay Manifold, and Metaculus, we had conditional estimates of US Democrat versus Republican president and many particular parameters about the country given who would win. That was advice to the voters about who to vote for. And hopefully we'll see more of that in the future. That is also decision markets. The problem here is just there's a common pool problem. People might like this information, but they might rather somebody else paid for it. So there's more immediate commercial potential looking for decisions where nobody else cares about your decisions. So if you don't pay for it, nobody else will. Now, this concept actually was implemented in 1981 before I thought of it by a guy named Jeffrey Wernick, who ran a finance simulation software company. And he decided what features to add to his software and who to hire based on these decision markets. He ran it for a few years, made a bunch of money, was a investor after that, and apparently none of his customers, employees, investors, etc., decided to copy this idea and do more with it. So then in 89, I first thought about prediction markets, and then in 96, I first wrote about decision markets, and then not much happened until 2022, 4 years ago. A secretive India-based government organization used it for a bit, but they don't want anybody to know who they are. And then MetaDAO started using it in 23, and the MetaDAO founder will be talking to you about in a minute. I'm going to, in a few minutes, he's going to take the stage. And then a couple of other crypto organizations have been experimenting with this in a couple of different ways. And so finally, we're seeing experimentation. But for a few minutes, I just want to talk about the big general idea before we hand off and hear more about the specific MetaDAO. So all innovation is combinations of simple, elegant ideas and lots of messy details. And I long ago worked out the elegant idea. I thought about some of the messy details, but honestly, I couldn't be bothered to work through lots more because nobody was interested. But now that people are interested, I'm going back to working out more of those messy details. So I want to just point out some of them to you. So think about this market across time. It turns out that what we want is to have a measurement period in which not much information is coming out so that we can see a clean difference between yes and no. So we want to create incentives to put information either before or after that period. And we can do that by adjusting the liquidity to be high before and after the measurement period. And people manipulate during that period, but then it'll be more clear that they are manipulating because not much else is happening, which is good. If one of these prices were become very unstable because its scenario became very unlikely, that could be a problem. So one solution to that is at, say, 5% of the time, says yes, we still do no. And that makes there's at least a 5% chance of the yes happening. We could do that with the other direction, except it's much more dangerous to randomly take stuff we would have rejected and approve it than to randomly take stuff we would have approved and rejected it. Because if we reject something that's good, it'll probably just be proposed again, and then we can approve it then. I have a long list of problems that people have thought about that I have solutions for, and I just now want to impress you with how many of them there are and not really go into the details. But there are problems with what's called a decision selection bias. You might want to be able to hide the prices, and that's actually feasible. If there's too many proposals, we might have auctions for proposal slots. And then to give incentives for people to do that, we might reward them somehow for proposals that are approved. There's a problem with the proposals that are so great that we're going to do it anyway later. So maybe we have to commit to not doing it if we don't approve it initially. We might have the wrong metric for some organizations, and we might then want to have markets that veto by saying, we're going to change this metric. This is not going to stand. In asset markets, we might have the problem that there's a limited number of assets that have infinite upside, so that limits who can be selling on the downside. So we then might want to swap in for bounded assets that then allow more people to participate. We might want to have the way that people could make amendments to proposals before they are finally approved, just like we do in legislatures, so that if you like part of a proposal, you think part of it's bad, that you could make a proposal to cut that out. There's potential ways people might try to commit to sabotage to change the bias the prices, so that's pretty hard. But more generally, we have this issue of how to fit this into governance structures, because a key obstacle actually in practice is that CEOs don't want to give up any control, and they'd rather just be able to make all the decisions themselves. And so proposing that they have more limits on their decisions is not very popular. But then what we can do is introduce this for decisions they didn't control anyway. So CEOs typically don't control many aspects of raising new capital, doing restructuring, mergers, acquisitions, etc. So we can introduce this at that level where they were already having to negotiate with outsiders to get approval, and we can have this be a better approval process. All right, so that's my very quick summary of Futarchy and some of the problems with it. And now I'm very proud to show you that somebody's actually been doing this for a few years, doing roughly 100 decisions already made. And so now, Prophet, please come up and tell us.
Hey, I go by Profits. I work on something called MetaDAO, which is, been focused on this problem of scaling decision markets or Futarchy to the world. And happy to talk about what we've seen. So just to give some high level context on like what our core business is, who we are, we believe currently that the killer app of Futarchy is crowdfunding. And so that's our core line of business. So we've done that for about a year, done $40 million raised for entrepreneurs across 13 businesses. And to give you some context, WeFunder, which is the biggest crowdfunding platform in the US, they had $70 million raised 6 years into building their business. And so it really does seem like this Futarchy thing actually helps. And what it helps on is mitigating fraud is a big problem with fundraising and reallocating capital from underperformers to overperformers. Or more broadly, we can say it kind of helps solve the principal agent problem for these crowdfunding platforms, or like the lemon problem. And so who are we? I was a software engineer before I got sniped by Futarchy, and my co-founder, he was one of the biggest market makers on long tail stablecoins. And now we have a team of 8 that is fully focused on this problem. And I think like the motivation for me originally was, I was working as a software engineer and I saw several misaligned decisions be made where working on a project, seeing feeling like everything is okay, but then the guy who ran the project wanted to get promoted, and so we had like 50 extra engineers staffed for the project, and he actually did get promoted. So like he was playing the right game within the system. It was just like kind of a shitty system, and I think decision markets are kind of like markets in general are kind of really cool because it's this awesome game where you have all the smartest people around the world compete to predict the future, and the people who are right make money and have increasing power in the game, and the people who are wrong lose money and have less power in the game. It's kind of like the political system where people who are not, like, you don't have to be able to convince people of your opinions, you just have to be able to be right over time, and like that's pretty sick. And so when I just came across a YouTube video where Robin Hanson explained Futarchy, and I was like, holy shit, this is going to change the world. And so what, like, okay, so you have this problem of like, you want to scale Futarchy to the world. You want corporations, governments, nonprofits to all use Futarchy to make decisions. So there's like a few first things you got to think about. Obviously for any product, you actually need to build the product, and then you need to go to market. And so it's non-trivial to build a financial product, right? Especially a completely new one, because there's regulation. And so there's kind of these two paths, which maybe we can call like the Kalshi path versus the polymarket path. Kalshi path is like you try to go regulated from day one and get approved by the CFTC, FinCEN, whatever. And then the polymarket path is you just deploy it to a blockchain and hope that you don't go to jail. And like we're taking that approach. And then if you take that approach of being on blockchains, there's some path dependence there where like it kind of makes sense to sell to people who are already comfortable with blockchains, right? Because now you've got to have, if you're a company making a decision, you've got to have all the relevant stakeholders be able to trade. And that's a lot easier if all the relevant stakeholders already have blockchain wallets, money on blockchains, and et cetera. And so what we started with is, you sell decision markets to crypto organizations. So this was a site of this project called Sanctum that was one of our first flagship customers. They did a couple of decisions through us, through decision markets rather. They decided whether to change their logo with a decision market. Where people were trading in that market is the price of their native token. So like basically, does it make the token pump if we change our logo to this? And that didn't really work. So like we had some traction, Like most of the organizations on the blockchain that we're on used it, but they weren't like heavily integrating into the organization for a couple of reasons. I think one is just like, yeah, like Robin said, like generally entrepreneurs don't want to give up control. And there also wasn't a huge upside for them to do so. And so we realized that fundraising, especially crypto-based fundraising, is kind of the perfect fit because I don't know if you've ever heard the term ICO or like, yeah, on-chain capital formation, like maybe you've heard of RUG as well. Like 70% of ICOs historically, which is like, yeah, it's an event where someone issues tokens in exchange for cash, they can build their business, turned out to be rugs. It was just like a blatantly fraudulent market where people would raise money and then just run off with the money. And that gets mitigated if instead of the money going to the people raising it, it sits in this treasury where like the market can move it. And they need to get approval from the market. They can't just spend it all at once. And so that is like our current business. And then now we're having to painfully move again because crypto venture as a market is kind of dead. Like people are not creating that many new exciting crypto projects. And then there's also fewer people who want to fund new crypto projects. And so we're focused right now, like we've just hired a head of founder sourcing, and we're trying to figure out like what non-crypto entrepreneurs would want to raise through this mechanism. I think we're trying to target markets that are not really well served by VC. So like the vibe coder market is actually kind of nice because there's like also rug risk. Like it's kind of hard to trust people in that market, and they're raising low amounts of money. And so it can make sense to use like a stronger investor protection mechanism like this. And yeah, so let's talk about like what we've actually observed over the like 2 years that we've run decision markets and over the 1 year that we've run this as a fundraising platform. And what is like decision markets seem to work pretty well at preventing fraud, like the core thing that we're using them for. So there is a company called Ranger Finance, just some crypto company, and they raised $8 million on our platform. And then there was an alleged revenue miscounting, and I like my GC makes me say the word alleged, of like they overstated the revenue by 4x, and then also it turns out all the users were like fake. And yeah, so the market rounded up real quick. Within 2 months, the market was just like, we're returning all this money back to the investors. Yeah. So that was a cool validation. And then it would also suck if like the market was always just like, hey, no, this is fraud, let me return the money. But here was a recent instance. So there's another company called Solomon that also raised $8 million on MetaDAO. And they created a proposal. So yeah, the way it works is like the money goes in, and then to move it or to move large amounts of it, you got to create proposals. And so they created a proposal to move $4.5 million into some like liquidity management strategy. And some people thought that they were committing fraud, right? And so they traded against this proposal. They basically expressed the view in the market of this token would be worth less if this proposal went forward because they're stealing the money. And so there goes the cash value. But people who are smarter than them bought them out, ended up doing $2.7 million of volume, which is like the highest we've seen so far in a single market. Yeah, and that was quite cool. And then it passed, and then fraud didn't happen. Like the people who thought it was fraud were wrong. And like it would have been, this was kind of the perfect situation because it would have sucked if no one had really watched this proposal and it just like went through. Or if it got rejected, but it was kind of perfect that like some people, because it did actually look like it could be fraudulent, it just wasn't. And so yeah, the market did the right thing there. But here's an example of like some shenanigans that can happen. So this other company called ZKFG raised about $1 million on MetaDAO. And pretty much everyone churned. Like a lot of people sold, and then the people who held on, because yeah, every project has its own token. A lot of the people that held on just like stopped paying attention. And so what this group of people who I actually like They're fully anonymous. I've never talked to them on the phone or anything. I've only seen their transactions on the blockchain. They created what I would consider like a bad proposal, one that was bad for ZKFG, which was to issue new tokens and allow them to be sold at a market discount when like they could have issued them at a premium. And historically, markets have rejected proposals like this. They created a proposal that was bad because, okay, yeah, so they wanted to like basically control this. Some funny things happened with ZKFG. The founder kind of like did some weird stuff, and they wanted, they basically wanted. I'm not going to tell you exactly what they ended up doing because I'll just say it's malicious because it's like so specific and nuanced to our structure. Um, but yeah, what they did is they actually they knew they needed to control the supply in order to get the second malicious proposal through, and they wouldn't have been able to control the supply if they. Oh, okay. They wouldn't have been able to control the supply if they had just like bought in the open market because people wouldn't have sold to them. And so what they did is they first created a bad proposal, um, and then that forced the people who were like honest and still there to sell into them because they didn't want the proposal to pass. Or like it didn't force them, but it incentivized them to do that. And then they sold into it, and then they had at that point they had all the token supply, and then they were able to pass this like second malicious proposal. It's actually passed yesterday, by the way. So we're still figuring out how we can deal with that. Okay, I think I've cut out again. Yeah. Okay. So here's another piece of data that we've learned about decision markets. Is that they don't like issuance at a discount. So yeah, for decision markets to work, you need there at least like in the traditional way of like you have a stock and people are trading on whether or not it would improve the value of the stock. You need there to be a stock, right? You need there to be like a liquid instrument of value that people can trade. And sometimes investors have tried to get access to projects that have launched on our platform or raised on our platform at a discount to the current market price. And so far, other than like a malicious proposal, like the previous malicious proposal, none of them have passed. And so, yeah, VCs have had a bad time trying to get tokens for below because like in crypto, you're able to really, like you're really normally able to get these tokens at a discount to the spot value. But the market doesn't accept it. And like, this is also quite cool because I think this is an illustration of markets solving the principal agent problem, right? From a founder's perspective, you basically like, yes, everyone wants to talk a big game about you want to reduce solution and you want that to some extent, but like also your biggest asset is your startup. And so for you, the biggest thing that moves the needle on your like risk adjusted returns is to bring in more money because that increases the probability of success, even if it's not beneficial to like the shareholders as a whole. And with this, instead of the founder deciding, it is the mechanism deciding. And yeah, it also is like nice bargaining power. Like people try to come to me and they're like, "Hey, I want the token at a discount." I could be like, "It's not going to pass through the market, so good luck." And then on the flip side of like selling, is that this is like quite sometimes annoying, but also a good illustration of markets is like, there are sometimes companies in public markets that trade for below their cash balance. So like, or their cash trades at below par. Like you can have a vehicle that has $100 million of liquid assets, maybe even cash, and is trading at like $50 million. And the reason why that is because historically, like you don't have a mechanism to realize that value. Like you can't just force the company to like give you back some of that cash or to like buy people out. But with decision markets, you can. And so, and this is for good or for worse. Like we pretty much every time a token trades for below its net asset value. So like, yeah, if you have $1 million treasury and the total market cap is like 800K, there have been proposals to buy back the token until it reaches that value. And this is sometimes return significant amounts of capital to investors in these companies. So like, Paystream was a company that raised on MetaDAO. They first did a 225K buyback below NAV. They then did, I believe, a 300K buyback below NAV. And they only raised like 450K. Wait, no, 550K in the first place. And so basically the market had kind of like lost confidence in them, and so it was in a sense kind of cool that it was it's a return money. The problem with this is that it makes it harder to sell founders, as you can imagine, on raising money if they know that their money can be taken away if investors no longer believe in them. Um, but yeah. Okay, so what are like the biggest bottlenecks in our business of like, because I really do think we think that uh, we think that this hack will actually, like, if we just execute it and scale it out, that this will lead to Futarchy essentially like taking over the world, right? Like if you just assume that decision market companies have a higher return on invested capital than like other startups or just other organizations with regular decision making, because they have better decision making, then over time they will just compound their capital faster, and investors will also be like only wanting to really deploy into Futarchy organizations because they know that they're going to get a better return on invested capital, for the same reasons why investors are like, if you want me to invest in your company, it has to be a Delaware C Corp, or like maybe there's a couple other applicable, like acceptable structures, but mainly Delaware C Corp, because Delaware C Corp is like helpful for preventing fraud. You can imagine a world in which like Futarchy is just the way that you have to raise money, because otherwise it's like investors think that you're trying to take their money or like steal their money. Mm. And and also just like higher returns, as I mentioned. But we still have like a couple of bottlenecks. So one that we actually now solve is low liquidity in the decision markets, and I'll talk about how we solved that. Low turnout, like with voting, not everyone shows up all the time. There's not a strong like people. Yeah, we've just not observed that. And then decision markets are obviously new. Decision markets require, like, at least if you're making company like huge strategic decisions, you require there to be a liquid vehicle that represents the value of your company. And I mean, startups are staying private for longer and longer. So like basically all the founders right now are voting against having a liquid instrument that represents their value. And we require them to do the exact opposite, like to have a liquid instrument very early. And then also like there's this question of bringing decisions to the table, and I think there's not strong enough incentives today for people to do that. And so, we solved the liquidity problem, actually. Like it used to be that early on when you traded the decision market, you'd get really bad fills. But we created this mechanism called Futarchy AMM, so like today, if you run a token project, you generally have to do market making in your tokens so that other people can buy or sell. And one way that you can do that is provide liquidity to an AMM. I'm not going to explain exactly what it is, but you can look it up. And so how it works is the companies are providing cash and tokens to a normal AMM, or like what is it starts as a normal AMM. And then when a proposal goes live, actually half of that liquidity goes from the normal AMM into decision markets. And so for the period of the decision, you can trade in decision market just as like they're just as liquid as the spot market for the token. And there's also like the AMM self arbitrages between the two markets to make liquidity even better and thicker. And so that's quite cool, and that we've solved that problem. One way that we're solving the turnout problem and like the proposal market problem is we're creating an activist fund to invest in exclusively companies that raise on our platform. It's going to be run like the proposal to our DAO just got approved. So we're anchoring it with $2 million of our capital. It's run by a couple of these two ex-founders who have worked together, and also they were traders. So like kind of perfect for this. And then they're raising from their network as well. Plan is to get is like a $10 to $20 million vehicle, with check sizes starting at $100,000. So like deploying into smaller companies. And it's going to take an activist approach. So it's like going to be raising proposals to companies like, if a company is not doing well, or like the founder seems to like not be shipping, like shut it down. or like restructure it. Like if so the company's going well, but then the founder is not performing, like maybe take him out of that seat, which like these are very this is obviously very contrarian in the world of venture capital, which is like going towards increasing founder friendliness, but like we're trying to position this as kind of founder rigor, where it's like, yeah, you have this world that's VC that's kind of like the playpen, or so to speak, like you won't get any oversight. And then this is like the Navy SEALs for founders, where it's like, we're going to push you to be better. And like, we're going to be actively involved in your success. TBD whether that works. But there's actually reason for it. Like historical precedent there, Sequoia started as an activist fund. They would invest in companies that other VCs didn't want to invest in and then try to make them better, like Atari. And yeah, we're also funding research into decision markets to like help with proving that they actually work. Because one thing that someone can say to me, and maybe some people in this room have thought, is like, okay, cool, it works in this like weird crypto world with these like degenerates, but how does it actually work in the real world? And yeah, so we're working with Robin to put people in labs and study like, hey, trade these markets and then see if they actually are better when they're trading versus the other ways of making decisions. And then, there's this pain point around having a liquid instrument of value. Specifically, the main problem for founders today is like, when your liquid instrument of value, your token goes down, people will shit on you, and it sucks. And I've gone through this process many times. And so, what we're doing is we're building a system of like curated investors. So in the same way that like Airbnb and other marketplaces solve the problem of curation on both the demand side and the supply side, as in like with Airbnb, buyers get reviewed, right? If they trash a place, we're curating a high quality investor list. And if people, do bad stuff, obviously we're gonna have to build a monitoring system, and it's probably going to be a huge pain in the ass, but like, I think marketplaces show it is a tractable engineering problem. And like only those people will be able to participate in these markets. So you don't get these like toxic holders, participating and shitting on you when your liquid instrument goes down. And then, I think the biggest thing other than the fun that's happening right now that I'm excited about is, pivoting to like focus on non-crypto founders. This was like a really small one. I guess the screen is not very high resolution, but this company called GSIM, which is just building like, it's pretty unrelated to crypto. It's just like an eSIM company with like a couple hundred users. They raised $28,000 on Metadao last week. So we're trying to get more and more of those companies. And as I mentioned, we're like focusing on the vibe coder market because I think it's quite interesting. And then so like all those bottlenecks that I mentioned, like I think those are engineering problems. We can solve them, except to apply man hours. And then there's also problems that we actually don't even know if they're solvable. Like one is deciding what decisions go to market, right? Like maybe you have it so that only a certain group of people can bring these to market, but then you get rid of a whole benefit of the decision markets of like the people who don't have political clout but being smart, being able to influence the decisions. Maybe you can potentially use the market structure itself to decide whether this goes live. Like maybe you have a prediction market, someone raises a proposed proposal, and then you have a prediction market on whether or not it would pass if it went to a full proposal. And then based on the price of that prediction market, like if it's like at least 30%, then it goes live. I don't know. The other, so decision selection bias that Robin alluded to, it's like a fairly nuanced topic, but I see it as kind of the one mechanistic chink in Futarchy's armor right now, which is this idea of, it's so like imagine there is a conditional market on the prediction market that I mentioned. So like you're betting in a prediction market on whether or not this proposal would get approved, and you know that it's only going to get approved, or like the decision is only going to go to the market if it's at least 30%. Then if you place bids at like say 10 cents, if you buy yes for 10 cents, or if you bid low, you know that you're really only going to get filled if the other people also think it's like new information comes out and the market trades above 30%. And yeah, because otherwise, if it just trades below, if it still trades at 10 cents, like your trade is going to get reverted. You're just going to get your money back. And so you kind of have like a free call option on it succeeding. Um, and that's a problem specific to decision markets. And then, yeah, I mean, the biggest problem like is giving up control sucks, right? Like that's going to be a problem that decision markets and Futarchy are always going to have. And yeah, so I think that's pretty much I think what we've seen thus far. I guess call to action or ask would be we've raised $12 million. We're hiring like really talented people who think that like Futarchy could be the future of human civilization and want to work on that across the stack, like engineers, designers, utility players. And then also if you're an entrepreneur who thinks that like, yeah, if you think Futarchy is really cool and like you want to experiment with raising maybe like a small project on it, I think that would also like, yeah, come talk to me, basically. But yeah, appreciate the time. Wanna
Wow.